Okay, Mike, getting back to your, what does the future hold? The arm's length standard, you're absolutely right, is questionable in a manner of speaking because it's so hard to apply in many, many cases of these large multinationals that are operating with unique intangibles. Think about Apple. Nobody else uses their operating system. There's no comparables out there for that. So, what's the future of this? Is arm's length going to go away? And I think the answer is no, it's not going to go away. As recent as mid-2010 are the OECD pricing guidelines, transfer pricing guidelines. And they say in no uncertain terms that all the countries have agreed that this is the standard which we will use, and there's no suggestion there should be anything else. The only place I see suggestions that there should be something else is primarily from academia, which recognizes that it's it's not necessarily always going to give reasonable results. So I don't think we're going to see anything anytime soon on that. Now, an interesting development, of course, is that the U.S. at least recognizes that a profit split method might be the most appropriate method in some cases. And that's really a formulary approach as opposed to an arm's length standard approach. So if I say, what about the future? Yeah, there will probably be increasing use and acceptance by tax authorities around the world of a transfer, of some sort of profit split approach. But to really go to some sort of formulary approach to allocate worldwide profits from a particular type of business, think of the amount of effort it would take to get all countries to agree on the same methodology. So I think it's, at least for the foreseeable future, I think it's a non-starter. It'll only happen, I think, on a unilateral basis, and occasionally, of course, through the competent authority processes where two countries effectively compromise on the basis of some sort of formula approach. Interestingly, I think, again, I distributed to you the administration's, or the Treasury, I should say, the Treasury's Green Book for Obama's 2012 budget, and that includes suggested changes to intangibles which would make goodwill and going concern values specifically to be something that requires taxability. And this is something that we'll talk more about when we get to the 367 area. Peter?
I have a question about goodwill. If in that example that we did where the U.S. transferred the goodwill to the Singapore joint venture, and there was no recognition of gain upon the transfer, what happens if the JV is then sold again? How will the goodwill component that was originally transferred from Lynn be valued? Would it be 50-50, or would there be some kind of split based on the goodwill in the normal sense among consumers?
Okay. You're asking, in a sense, several questions, but to try to get to the first thing, the first question is economically what has happened. So, for example, if it's really a 50-50 joint venture and goodwill is transferred in and now that goodwill is owned by the joint venture, then economically, if that business is later sold to a third party, and the goodwill is realized in cash that's inside that joint venture company. If it's really a 50-50 joint venture, then both parties ultimately realize 50% of the cash generated from that. So the first thing is that economically the arrangement? Now, in terms of the way that situation in the case, the course fact pattern was set up, yes, that's what would be intended. That it really is an economic splitting. Now, the next question is, okay, gee, we transferred these assets in, and we get this benefit under 367A that the value of the goodwill and going concern value doesn't get taxed at the time it goes in. If it then gets sold, does that cause some recalculation under your 367 rules to now somehow hit the U.S. transferor that transferred the goodwill and going concern value? And that's a separate issue which we won't talk about now. But yeah, but anyway, the starting point is always economically what's happening. Forget taxes. Economically, how is the gain being shared? Now, this change, going back to your presentation, this change would now cause there to be immediate taxability of that goodwill under 367D. Or I shouldn't say immediate taxability, rather the deemed annual payments under 367D. Okay, just a moment. This point of can subpart F be a backstop to 482? Okay. The transfer pricing rules are so terrible to apply. Let's assume that, in fact, a company has, in fact, used transfer pricing and, as a result, has a lot more income than it should, so to speak, in a tax haven company. Now, if they happen to have put a lot of income into this tax haven company, and if the transactions that earn that income happen to be foreign-based company sales income, foreign-based company services income, then that artificially high income is immediately taxable to the shareholder in the United States. So it really doesn't matter if the transfer pricing is wrong, as long as that higher amount of income gets brought back and is taxed currently anyway. So yes, the CFC rules are in a way a backstop to the transfer pricing rules. Now that's nice to say, but of course the way that most major companies are putting together their transactions, they're structuring them specifically not to be foreign-based company sales income, foreign-based company services income. And there's no backstop. Now, one of the obvious points is, if there's this big hole which exists because the defined categories of foreign-based company sales income, foreign-based company services income are so limited, and everybody is structuring their transactions to avoid these, then the obvious point, which is again included in the Green Book, is let's create another category of subpart F income that somehow catches some of this. So that's one of the items that was in the Green Book that I sent to you. Now, will either of these two items find their way into legislation? Who knows? I'm not sure I would give any of it a better than even chance, but who knows? So we may be surprised.